I usually see two schools of thought when talking about stocks. In The Wolf of Wall Street, Matthew McConaughey tells Jordan Belfort that no one knows if a stock is going to go up, down, sideways, or in circles. This view basically treats the stock market like the casino. The other school of thought uses Fibonacci sequences, technical analysis, and candlestick patterns. This one is basically just astrology. The third and final view on stocks, however, is called being a nerd. Before we start talking about stocks, I want to propose a little thought experiment. Imagine a golden apple that every single year will pay out $100. In 2 years, I will have made 200, year 3, 300, and so on. Furthermore, this lucky apple will do this forever, a guaranteed $100 a year until the heat death of the universe. What do we think is a reasonable price to pay for this apple? 1,000? 10,000? Maybe even a million? To answer this question, we need to learn what a bond is. Okay, calm down with the booing, I'll make it quick. As you might have heard, the US government is in a lot of debt, 38 trillion to be exact. This means that the US has borrowed $38 trillion from investors around the world. The federal government though doesn't send Venmo requests to investors, instead we buy bonds. If I buy $2,500 worth of US Treasury bonds, I am effectively loaning the US government $2,500. Of course, we're going to want that money back, but also a little extra for the cost of letting the US borrow it. This cost is called interest, and the US pays about 4% on 10-year Treasury bonds.
I told you, I need more time. I don't have the money.
Then fucking get it.
What if the US can't pay us back? Impossible. The US Treasury is the safest asset on the planet. In fact, this money is so safe that this 4% is called the risk-free rate. When I buy $2,500 worth of UST bonds, I will profit exactly $100 next year through the interest payment. $100 a year of risk-free guaranteed money? Sounding familiar? A perpetuity is a cash flow that continues on forever. To get the present value of that perpetuity, we divide the cash flow by the interest rate, giving our apple a price of $2,500. A stock is a fraction of ownership in a company. When Vanguard owns 1.4 billion shares in Apple, they have a 9.5% ownership of the entire company. When you buy a stock, you're buying a claim on the business. Your claim is to all future profits, stretching infinitely into time. And that's the essence of a perpetuity, an asset that generates cash flows forever. Given our Apple is worth $2,500 today, what's the present value of another Apple that produces annual cash flows of $100 billion? If you said 2.5 trillion, you're close. But to actually answer this question, we need to look at Apple's financials. Operating income and corporate tax rate are on the income statement, amortization, depreciation, and capital expenditure are on the cash flow statement, and we also need to find change in net working capital, debt, equity, beta, and a few others. With our accounting numbers, we can forecast Apple's future cash flows, then we need to discount the cash flows to its present value. To get the appropriate discount rate, we use the weighted average cost of capital WACC, where the capital assets pricing model tells us to multiply Apple's beta by the market equity premium, usually between 4 and 5%. Then which we add to the risk-free rate, multiplied by our equity to debt ratio plus the cost of debt times 1 minus the corporate tax rate times our debt to equity ratio. This gives us the WACC we can use to discount all of our future cash flows. Estimating the terminal value with our Gordon growth model, which looks very similar to the perpetuity formula, putting G at around 4% to account for inflation and GDP growth, we get Apple's terminal value. Now discounting all of our projected cash flows by our WACC and the terminal value to the present value, we get an enterprise value, in which we need to subtract net debt, minority interest, plus cash, all divided by our number of shares outstanding. We get a range of about 140 to 190 for Apple's share price, at exactly $3 trillion of enterprise value. The discounted cash flow model, DCF, is a fundamental valuation strategy for stocks, and it's the first thing you learn going into finance. Every single investment banker on Wall Street, I can guarantee you, can tell you how to build a DCF from scratch. Of course, if you look at Apple's share price, it is sitting around 270, and it seems like our DCF is pretty useless because our estimate is just wrong. Luckily for us, there's about 20 other valuation strategies that I will discuss briefly. APV adjusts our present value to account for tax shields and cost of financial distress. Gordon Growth uses dividend payouts to estimate growth in valuation. Residual income adds book value to present value of excess returns over cost of equity. Trading multiples compares ratios like price to earnings with peer companies. If our companies have the same numbers as another, they should be valued the same. Q is literally just the cost it would take to replace every single asset in the company. Real options is applying derivative logics to financial decisions, looking at the probability of certain events occurring. Consult Black-Scholes. To add some depth to your analysis, you can add a Monte Carlo simulation as well, and these are actually super cool. If everything so far seems complicated, it's because it is. To understand stocks, you gotta learn from the ground up. And I know you don't want to hear it, but you need to know how a bond works. You need to learn to walk before you can run. Bonds give the risk-free rate, and you'll see it everywhere. CAPM, WACC, Black-Scholes, Gordon Growth, and basically all valuation of financial instruments. When this guy takes triple levered IV derivatives on the S&P across 5 ETFs, its valuation depends in part on the risk-free rate and zero coupon bonds. If you want to learn finance, start with bonds. I know this was titled and supposed to be a video about stocks, but if you got this far and am disappointed it was actually a video about bonds, I'm sorry. Part 2 will be about markets and buying selling stocks, so stay tuned.